Hello everyone, my name is Adriana Calderon. I'm the lead partner for Transfer Pricing Solutions Asia, a firm based in Singapore. And today we're going to be talking about managing the impact of COVID-19 on transfer pricing, focusing on intercompany loans. Before we get into the topic, a quick overview about our firm. We are a specialist firm that provides practical, proactive, and cost-effective transfer pricing advice. We are a group of advisors from Big Four and mid-tier firm based in Malaysia, Australia, and Singapore. I am the lead partner with 15 years of experience in advising multinational companies on how to manage their transfer pricing risk in a wide, broad range of industries, business models, and transactions. So as you all know, or if you don't know, IRS issued TP guidelines in September 2020 to advise on the impact of COVID-19. And that TP guidance covered basically 4 key points. One was the need of preparing an industry analysis to support the impact of COVID-19 in your industry. For this, what is important is a robust analysis with reliable data that show evidence of the impact in the industry. Point number 2 is the need of a functional analysis that cover first any recharacterization of the entities by covering the functional analysis before and after COVID, and also to support which entities in the group made decisions related to the management of risk relating to COVID-19. Point number 3 is the need to have robust impact of point 1 and 2. And the last but not least is the change in economic analysis, whereby IRS allows a concession of multi-year analysis, meaning 3 years analysis as opposed to 1 year, to compare the profit or the actual outcome against the comparison or against the benchmarking analysis to decide whether a TP adjustment is made or not. As you can see, these 4 points cover a lot of the situations that distribution entities could be in, but it doesn't cover the issues that can be arising from intercompany loans. So let's see a couple of key TP aspects of intercompany loans. With intercompany loans, we have to have a clear transaction delineation whereby the intercompany loan is being supported as a loan as opposed to equity. Then there has to be a contract and there has to be a TP analysis that supports the interest rate. So why is loans an important transaction to manage during COVID-19? First of all, it's considered a high-risk transaction that attracts attention from tax authority. Why? Because it's very easy to set up a contract and agree on an interest rate that can shift profits from high tax jurisdiction to low tax jurisdiction. It affects the interest income or interest expenses deduction under general tax principles. It is relevant for determining when credit facilities should attract interest rate if the loan is more in the nature of equity. And it impacts interest deductibility and the interaction with general tax rules, such as thin capitalization rules and fixed ratio rules. So the key in intercompany loans, apart from the interest rate, is also whether the transaction is a loan in substance for domestic law purposes. And for this purpose, it's very important to talk about an actual delineation of the transaction, the commercial and financial support or arguments that allows the taxpayer to support the loan to be a loan in nature, and the economical relevant characteristics of the financial transaction. This is really important because the substance of loans are primarily driven by the contract, and the key terms of the contract that basically supports the loan to be in nature or in substance of loans are critical for the loan to be a loan for domestic purposes, and therefore for the interest expenses to be allowed as a deduction. So now, what are the issues that can arise for from COVID-19. So let's see this example. We have company A that is a distributor of electronics and provides a loan of 13 million to company B located in Malaysia. So some of the issues that can arise are basically circumstances where maybe company B is not allowed or doesn't have enough cash flow to pay the interest rate. So what does Singapore company A can do? So I think in these situations, what we have advised our clients is looking at these four things. So what to do if a related party entity cannot pay interest rate? So point number one, reconsider the renegotiation of terms and particularly the interest rate. But that is something that cannot be done retroactively. It has to be considered in the future. Consider potential delay of interest payments on temporary basis, especially if in the country where the borrower is located, banks have allowed for temporary delay of interest payments. That could be a robust argument to say that delay of interest payments is allowed during extraordinary circumstances like COVID-19. You could also consider a recharacterization of short-term loans into long-term loans and potential renegotiation of interest rate. As with everything in transfer pricing, each renegotiation needs to be documented and it needs to be addressed on a case-by-case basis. If you have any questions, feel free to contact us on the following details. Here is my email address, our office telephone, and also feel free to follow us in our social media channels such as YouTube, Twitter, Facebook, LinkedIn. We're always publishing valuable information to help multinational groups on how to manage their transfer pricing risk in Singapore and Asia. Thank you.